Good morning, Rumble and YouTube and X.
All of us.
All of us.
We are live, and I am here.
Brian is here. He's in person. You made it. He's
I can drive.
not dead.
No, I can drive, and things are progressing nicely.
So welcome everybody. We have not done a deep dive in stocks in a while, and we need to do one because we have to buy a stock this month to increase our passive income. Got the portfolio shown on the thumbnail. We've got it up here on the screen for you, and we also want to show you where our passive income is at. So this account in particular is up to about $319 almost every single month. That is exclusive of whether or not the stocks go up or down. So when the market crashes, like Bitcoin has been crashing lately, we do not care. In fact, we typically get kind of greedy when that happens because things go on sale and everybody likes a good sale. So this month there's a few things that I want to look at inside of the position. So what we're going to try to do is we're going to try to buy a stock. We've got about $2,400 to purchase this month, and we put a bunch of the stocks that are in our portfolio right now into a screener with AI. And I typically, when I buy something, I like to buy stuff that's beat up. We like beat up stocks. So what we were thinking of originally was, let's buy these ones that are really not doing so good, and then AI threw us a curveball, and we want to check that out. I'm not sure if it's, sometimes when AI thinks it's right, it's just like way off base.
It hallucinates a lot. So.
It's like way out there.
It's getting better and better.
So we're gonna check it out. We're gonna see if maybe like it recommended Pfizer, so we're gonna check out Pfizer. I really wanted to look at Kimberly-Clark today and see what's going on with them. We've got a few articles too that we want to go through with you guys, and then also we have our Seeking Alpha partnership, but in there we put our portfolio in it, and you can kind of see what we look for in terms of the businesses that we like to invest in that way. So interestingly enough, somebody asked us about Anelli Capital last week, and you'll notice that their profitability grade is a big flat nothing.
Yeah, there's not a lot that Seeking Alpha says about Anelli. It doesn't keep those stats.
Because they're not profitable.
Right.
And they're an IRIT, so that's...
Yeah.
I guess with all this said, there's a few things that I think that might be interesting to some people, because I'm not sure a lot of people know that when you invest in the market, you're still at risk. And when you're talking about like big crashes in the market, runs on the bank, 401ks getting liquidated, those kinds of things happening, there is a little known law out there that basically means that they can freeze your account. So let's say a crash happens, you lose your job, you need to pay your mortgage, there's something that's going on. And I've actually seen this happen. I don't know, have you seen this happen to you as well?
I have not.
You have not. So Brian doesn't care if the market crashes, he just kind of ignores it.
Yeah.
So I remember this happening in 2008. It happened during the flash crash. In fact, I was talking to my father-in-law when the flash crash happened, and I remember seeing the portfolio go down by like $30,000 in an hour. I'm like, what is going on?
Oh, yeah.
They pulled the breaker.
I watched that too.
They pulled the breaker on the market. So
they stopped trading. We're not going to trade anymore. This is crazy.
yeah. So there's been a few instances in all of my time of investing that I've seen this happen. It's not very common.
During the IT glitch, when the servers went crazy and it dropped like 80%.
Oh, the algorithm. Yeah, the algorithms
went crazy, and they stopped. They stopped for like 2 or 3 days. Well, they had to fix it, but that was another one where they had to quit trading.
They called that pulling the breaker.
Yeah,
like that was we had to pull the breaker, and I'm picturing some guy go into the back room, is like, pull this big old switch, and it's like, that's not really what happens.
No.
They make a phone call and a guy shuts down the computer.
Yeah.
But that's about it. So what I want people to be aware of is that this is the first article I'm going to show everybody before we get into the stock analysis, and this really gets to the point of what I like to tell people about dividends, because most of these businesses, even during a crash, even if your portfolio is frozen, will still get paid. So chances are you will still get your money. But what this basically is here is this is an article from Fox. We typically go to all sources: Ground News, CNN, Fox News, Wall Street Journal, Bloomberg. We go everywhere. So
Yep.
today is Fox. So don't criticize me for being on Fox. But basically, because of a largely unknown legal changes, millions of Americans could temporarily or even permanently lose their retirement and other investment savings during the next major financial crash, all while the too big to fail Wall Street firms and banks are protected. Might sound like a wild conspiracy theory, but the danger is real and pretty well documented. So when you get a chance, take a look at this article, and it talks about what happens. I don't have to get into all the details unless people have more questions about it. But essentially what it boils down to is that if there's a run on the banks and the Fed can't step in with their float, they do like repo swaps and stuff. Essentially what they will do is they will stop trading. So in other words, you go to get your money ain't there. It is there, but you can't get it.
Right. You just can't withdraw it.
Right. So be aware of this, that when you're investing and when a crash does actually occur, you might not be able to get your money as soon as you think you can get it. And even then, the thing I like to tell people, and it's because, in fact, I was riding home with somebody from work yesterday, and he was asking me, so like, what happens when somebody's raising $150 billion of capital? And, you know, what happens when you're buying a stock? What happens when you're selling stocks? He has all sorts of questions. And I kind of told him something I'd like everybody else to keep in mind. Hey, Matt, welcome to the, well, you're here early today.
Yeah, you are.
So I guess I told him, when you're selling a stock, you're selling an equity stake in the business. That somebody has to buy that. So you're selling it to somebody. So somebody thinks it's worth more than you do, and you're selling it to them for whatever the price is at that time. When they sell a stock to you, they think it's worth less than you do, and you really need to ask yourself why that is. And I got into a whole tangent. He said I was bouncing all over the place because I never do that on the channel either. But so have you seen GE Aerospace over the past couple of years? I did. I actually invested in them when they crashed. I put, what was it, 20 grand or something into them? They went up to like 40 something, and then I sold them and I bought something.
They did some reorganization of their company.
Yep. One of the employees at my company, actually, she was laid off from GE during the downturn. So when the downturn happened, she was let go. We brought her into the company. She's here for a few years.
Yep.
And they were recovering. She had all this inside knowledge about what was going on with GE. And I told her, no, I think they're going to recover. And she didn't think they would, and they did. And we can look at them in a minute if you want. But back to my rabbit trail of a thesis here for your 401k. During the recession in 2008, the market was crashing. I think it was over 42% by the time that I thought about, well, maybe I should take the money out of it. And I didn't. And because everybody was selling, the companies will declare a dividend X date. So basically what that means is they will say, this is when you have to have this stock before this date in order to get paid for the dividend. Well, a lot of the people back in 2008, a lot of the businesses declared the X date, and then a lot of the people sold, and they sold fast. I mean, it was like
It was a huge sell-off. It was fun watching over the next couple months go down by 200 grand.
just every week. So this X date went through, they declared their dividend, and half the people owned the stock. So I remember having AT&T stock back in the day, and I think they paid me on average like $120 or something like that every quarter. And because there were so few people that owned the stock during the crash, I ended up getting like a $600 payment. It was crazy. And it lasted for 2 years like that.
Like, well, this money was going to go to these people, but since they sold, I guess we'll just distribute it to whoever's left.
I will mention, though, that a lot of the companies in the portfolio, over the next 2 quarters, they corrected that. They fixed the numbers, but some of them didn't, and I ended up making just a ton of money in dividend checks just from that. So I bring that up because when you look at this article and you look at them being able to freeze your 401k and how this all pans out, at that time, my 401k, I believe it was with Slavic at the time, That got frozen. And my Scottrade account, because Scottrade existed back then, that also got frozen. So I couldn't, like, for at least a few weeks, couldn't get my money out. And even when I did, like I said, when you're selling a stock, somebody has to buy it. So if you're
Yeah.
trying to sell a stock when the market's, what'd you say, 200,000?
Yeah,
That's a lot.
that is. And you got to keep in mind that these banks and institutions have to give you the money, right? So they generally don't have enough money for everybody to pull their money out at once. So that's the biggest problem is when you got a big sell-off and everybody's trying to get their money out, they don't have the actual capital to give it to you. So they got to come up with that money to be able to give it to everybody. So of course they're freezing everybody's withdrawals so that they can come up with this capital to give it to the people who are actually want their money back. But in the meantime, you're stuck. You can't withdraw. So if you wanted to get out, you couldn't, you know?
And there was a lot of that going on, and that contributed to the month-long, like, downward spiral.
Yeah. I didn't want to get out. I put more money in.
I did too.
So
I mean, I made a lot of money I made a lot of money. I wouldn't even be
I
here.
lost a lot of money, but then I made it back. But it's people like my dad who is counting on that for retirement, that hurt him pretty bad, you know, during that time. So
This lends credence to what we're trying to talk about. When we're talking to people about investing, dividend checks, what stocks we're buying, what the companies that we're about to go look at, we want people to understand that during bad markets, during downturns, during recessions, if you're trying to get that money out, you're trying to do it in an environment where everybody's running to the exit anyways. Who's going to buy your stock? Brian and I probably will buy your stock, but most other people are all running to the exit.
Yep.
So what's it really worth then? You're going to sell it at a huge discount. And we got this other article. So there's two articles I wanted people to look at this week. This one is Justin Bieber. I can't say his name.
Biebs.
Good grief, Biebs. He's such a great singer. Isn't he such a great singer?
he is a good singer.
Really?
Yeah.
You listen to Justin Bieber?
Yeah, he's actually a pretty good singer.
Brian listens to Justin Bieber.
Why not?
Really?
Yeah.
Yeah, I thought you were a classic rock guy.
I listen to all sorts of things. I listen to metal. I listen to Metallica and stuff. I listen to contemporary, you name it, except really country. But
What you're supposed to say is, Tom, every time you send me some kind of IT request, it's death metal. Let the bodies hit the floor. And then like at the end of the day when my wife
Johnny
comes
Cool.
home, we're listening to like Dance of the Sugar Plum Fairy. It's nice little opera music.
Yep.
It's so wonderful.
usually when I'm driving, though, it's some sort of hard rock. You know.
Yeah, it's because people in West Michigan drive like they're listening to hard rock.
Caesar, yeah.
Horrible drivers. So Justin Bieber bought this. I thought it was crazy. These are called NFTs. If you're not sure what this Bored Ape thing really is, it's not a Wolf of Wall Street or a Wall Street Apes thing. They do use that image, but basically he bought this encrypted NFT image for $1.3 million. And people, it's like art, right?
Yeah.
People thought it was worth this much money, so they paid that much money. And I remember telling my sister a long time ago that when she was trying to tell me how much her Mustang was worth, it's not worth what you think it's worth. It's worth what somebody else is willing to buy it for. And according to, like, she didn't like that, but it ended up being true when she finally went trying to sell it. So this thing he paid $1.3 million for is now worth $12,000.
Shocking.
Isn't that, I mean, it's almost like it wasn't an investment.
It could have been. You didn't know. It could have been something that just kept going. But I mean, this really came out in 2020 when people had not a lot to do and a lot of money through whatever. I mean, Biebs, of course, is a very popular singer, so he had some money to spend, right? He had millions of dollars.
Didn't he rent like the whole stadium out for Selena when he was dating her or something like that?
Oh yeah.
I mean, I can't bet. How much do you think that cost?
A lot. And the Fisker, that shiny mirrored Fisker, that gold Fisker that like blinded everybody when he was driving down the street because it was mirrored.
Oh yeah, yeah, yeah,
Someone
yeah.
hit it.
he ended
Blind
up,
everybody.
I remember he can't drive that anymore. I think.
No,
Like,
they said he couldn't drive it anymore or change the paint job. So yeah, these things, they had an opportunity that could have been something like artwork, like Banksy taking I think it was Banksy like duct taped a banana to the wall and called it art, and somebody bought that for $1 million. You know,
I saw that and I thought, what are you doing? Like they probably just really like the artist and they're trying to,
Yeah.
starving artist. Maybe
Yeah.
they're funding him, but still, you got that kind of money to pay for a banana?
art is very subjective, so this could have been something that kept going. But I think one thing that Bored Ape did that they didn't realize was they proliferated the market with Bored Ape artwork, and so it became less and less valuable.
To Brian and I, that's not an investment.
No,
This is not how you make money.
this is a hobby.
This is why the ape in the photo here is crying.
He's so sad.
He's very sad. And
He's bored to tears.
he thought he was worth something, but it's like your dad telling you were a blue special over at Kmart when you were a baby and you believed him.
Yeah.
That's-
Now,
yeah.
if you want to look silver lining and optimistic, it's still worth $12,000. That's still a $12,000 little piece of digital.
That's optimistic. It's worth 1% of what he paid for it.
Right, but if you bought it today, it's $12,000. I mean, it's 12 grand for a little piece of digital hard drive space. You know,
I would say that that's going to go to probably $1
someday.
someday, or he'll like lose it, like his hard drive will crash or something. He'll get a virus. It's just
The
gone.
server will not be available anymore that it's on.
Because that never happens to any crypto ever. So, with that said, when we look at stocks, and we're going to look at them here, and we look at the positions that are in our portfolio, we're looking at them from a intrinsic value of a few things. They have to produce a product or a service that somebody needs to have or is pretty darn close to it. Sure, you don't necessarily need to shop for Campbell's soup stuff, but I would be pretty sure that if people stopped buying goldfish, children everywhere would revolt and the world would fall into chaos. So, what you got? So the second thing that we're looking for is we want products that people have to have. Why do we want that? We want it so that we know when we're getting our dividend check, we're getting it from the profits or the proceeds of their service or the products that they're selling. We've seen a lot of instances, in fact, Anali Capital is a really good example of that, where you have something called NAV, like loss, net asset value depreciation, where they will sell a building or they'll sell some of their assets and use the proceeds from that to then pay like a special dividend out to people. That's not how we want to make our money because that's not sustainable. What are you going to do? You don't have a building now.
Well, it's not predictable either.
For the most part, yeah.
I mean, you could say, okay, they had this, they depreciated over so long, and they tend to sell their assets after so many years. Just to,
I was going to bring up banking. Think, well, banks have they do this all the time, but that's different. They do lending, so those are the two things we're looking for. And the reason why we do that is because this is why we get these numbers that we do. And I found that over the course of 24 years of doing this, I've had a pretty good track record about getting somewhere around 20%. But for whatever reason, once I get past 20%, I kind of get stuck at the same number that Warren Buffett gets stuck at. Like it just kind of caps there. Something happens. There's always like some extraneous world event or something that goes on outside of my control that changes the value of one or two of the stocks. It's like, well, I guess, but still, I'd say that's still pretty darn good. And we're approaching that now even. So that said, the ones that we're looking at today are not going to be the ones that are doing really well. If we do look at ones that are doing really well, for example, like 3M or AT&T or Intel or any one of these ones, we have to see like it's called the trailing price to earnings ratio. We have to see the value of the company increase relative to their sales. One of the reasons why we don't jump on the NVIDIA bandwagon, at least not right now, is because sure, they're growing, but the fear of the FOMO guys that jumped in on the stock, the hype they ballooned it way past what we believe is a value play. So we're really looking for a company that is mismatched in terms of what their value actually is compared to what they're doing. And we've, as you can see, we're pretty good at finding them. This is not what we base our portfolio numbers on, though. So if you're looking at like, oh wow, this one's up 100%, you guys did really good. This one's up 50. These are really good numbers, right? That's not what we should care about, because again, we want the companies to do well.
But we did do pretty good, and we like the dividends, and that's why we make a lot of our decisions is based on the dividends. We want to get that monthly income, that passive income, so we don't have to worry about anything when we get that to a certain number. But we also like beat up stock. We like to get that growth, and that's a bonus to buying the dividend stock.
Yep.
It's not just buying it for the dividend. We look for something that's beat up that is profitable. Then we go through the list, and it's all A's and A minuses of profitability. Rumble.
The only F. Here it is. So if you want to know what we buy, there you go.
But that's why we do that. That we like a profitable company that makes money, that has a good product, that just so happens to have, I don't know, had some sort of downturn because of whatever, that we know they're going to come back after that. So why not buy it while it's low and hang on to it and enjoy the profits from that, as well as the dividends. Now, we rarely sell to get those profits, but eventually we will, right?
Eventually. Brian doesn't let me sell anything in this portfolio to buy stuff.
No.
I like to buy things, so I have to do it in the other portfolios I have. So I guess I have to figure out with that mindset, if I'm not going to buy something with this, then what do I do with Intel when it keeps growing to the point where it balloons, or they make a stupid decision like I guess they fired the CTO guy at Campbell Soup because he was like, only poor people.
Information technology, yeah.
Yeah, like only poor people buy our soup.
What an idiot.
You work there, dude. Change the product if you don't like it.
Now, I'm not against selling per se, because if we have something that is, this great opportunity for what stock, Pfizer is down 50% and they didn't deserve that, I have no problem selling one of our 100% stocks to put it into Pfizer to make even more money, right?
Yeah. Speaking of that, we did sell. Honda Motor Corp was one that we sold. It was up like 46 or something percent. I don't remember what it was. And then we also sold most of our shares in Comerica Bank because we saw a financial problem. Now, when a company's not doing well, the vultures start circling, and usually it's larger companies coming in and saying, hey, you look kind of nice right now.
How would you like to become Fifth Third?
It's kind of like when you're dating in your 20s, everybody's really picky. But by the time you get to 40, a few extra pounds here and there, 5 or 6 kids, felonies.
5 or 6 kids.
Felony arrest records. It's okay. She might smoke like a chain smoker, but that's okay. It's okay.
I could change her. I can make her better.
And that's kind of what happens to businesses that are down the out. So when we sold Comerica Bank, we saw this. We saw they were over leveraged, and apparently we weren't alone because Fifth Third saw it too, and they bought them out. So
we're just a little early.
We jumped the gun a little bit, but we were right about Honda. We kept one share just to keep track of it and see, okay, well, were we right? How did this go? We were wrong about Comerica because Fifth Third came in and bought them out, and that happens a lot. In fact, one of the companies we're going to look at today was Kimberly-Clark, and they used to have, Johnson & Johnson used to have a company called Kenvue. They spun off from J&J, and Kenvue, J&J riddled them with debt and financial stuff, and now Kimberly-Clark is deciding to buy them up, and then the cost of doing that is affecting their stock price. So this stuff happens all the time in the market. If it's a big mid to large cap company, acquisitions, spin-offs, stock splits, it's very common. So you have to pay attention to what happens. Like we've had this happen now 3 or 4 times.
Yeah, and
in
that's
our
why you
portfolio.
can't just use valuations and ratios and the numbers to make these decisions. You also have to go to the articles, to their earnings calls, and all the other rumor mill to figure out, okay, is Fifth Third going to buy Comerica? And if they do, then what's the ramifications? If it's going to go up, then you hang on to it. If you think it's going to go down because of this, then you sell. But if you're just looking at the numbers, you'll never know that a Fifth Third is going to buy a Campbell's or a Comerica, you know?
Yeah, you would never know. You would never know. And the last thing I want to get into, and if you guys have questions about what stocks like you may think are interesting, post them in chat. We'll take a look. Hopefully we got enough time for, like we can do that now. I'm not sure in a few years we'll be able to do that, but we'll see.
We'll see if we can get to the tariffs in a little bit.
Yeah, remind me on that.
Yeah.
Don't let me forget that.
Maybe my coffee will be like drinkable by then.
I like it boiling hot. Brian doesn't like how hot I like my coffee.
I like to taste things after I drink some coffee, you know? It's 190 degrees burning my tongue.
So before we get into stocks, there's one last thing I want people to pay attention to, because a lot of people don't understand like how equity is raised for the stock market. I'm probably going to oversimplify this massively. If we looked at like an aerospace company called Doroni, and I think they still have it on their website. I'm going to go look. Yeah, let's see if they have it here. Yeah, so these guys, they were trying to raise capital, and essentially what it was is they were doing a issuance of shares at $3, just over $3 a share, to put into the business. Now, what that meant was you were going to give them money to build up their manufacturing process so that then they could grow the company and your shares, in theory, would be worth more. That's basically how the market works. If you start a business that's private, if it's like an incorporated business, you have shares of that business. I think the default number is 100 shares. So if I started a company, I'm going to throw out some numbers here. Let's say I've got Tom Incorporated,
The
The
Tom. It's gotta be
Tom.
I don't know
The
why
Tom.
it has to be in there, but it always does.
It's going to be The Tom Inc. So The Tom Inc. has 100 shares by default. Let's say The Tom Inc. goes to $1 million. Each share is then basically worth $10,000. And that's based on revenue. So when people say, well, Elon Musk and Mark Zuckerberg lost $43 billion in a day, they didn't physically lose it. Like, it's not sitting in their bank account. It's the price of their assets that they own, in this case their businesses that they run. So their businesses lost value, ergo they are worth less. This is why when we talk to people about the housing market and we say, hey, your net worth isn't what you think it is as the housing market starts to crash, that's why we say that. It's not any different in that case. So these guys were trying to raise some money. And the biggest difference between a business that has shares that wants to raise more capital, and you have to go public to do this, unless you find private venture capital companies, and that's a whole different conversation, but like a Shark Tank thing.
Yeah.
So,
Angel investors.
yeah, if you wanted to go public and you wanted to issue shares out to people, you would divvy out your company, you would have to have board meetings, and those people on the board would like have to tell you what you would do, what they think is right. They would get to vote. They're based on how much money or shares they own of the business, and that vote would then determine where the trajectory of the company would go. So this is the only country that is free enough that you can just basically have a good idea, try to crowdsource the funding for it, and actually become successful doing that. And there's not a lot of things, like they don't teach this in schools. It drives me crazy. I think they need to. But back to those 100 shares, if your company becomes a $10 million company, let's say you go from $1 million to 10, your same shares, now you didn't like actually put the money in your account. So you still have the same one share or 10 share, whatever you've got, they're now worth $100,000 per share instead of $10,000 per share. So your net worth went up, even though on the surface it doesn't even look like you made more money. Now, from a business standpoint, if you went to go sell those shares, so if you said, hey, I need to cash in on that, the business has to pay you that amount in some way. Or another shareholder, like somebody else will buy it from you, or a bank or something else like that. So essentially, you can make money doing it that way. Now, the cool thing about a business, if you're a business and you want to raise capital and you're issuing shares of your business, or like an LA Capital, you're just issuing stock shares like it's free candy, is that you don't have to pay that money back. So if you go bankrupt, and let's say it's kind of like what's going on to Justin Bieber's little NFT ape there, it's worth what, $12,000, 1%.
Yeah.
So if I went from $1 million down to $10,000 as a business, it's kind of what it feels like, honestly. It's like running a business feels like that every day. So, but if I went down to $10,000, each share would basically only be worth like $1,000.
Sorry, kid.
So, actually, no, it'd be worth less than that. Can do $100. So, yeah, you would have $100 of total net worth if you had only one share. So the point I'm getting at is, in the public market, in the capitalistic society, that's why we tell people that we see this as a loan. We've been trolled for this before. That people says, "Oh, it's not technically a loan." No, it's not technically a loan, but you are giving them money to grow their business. So in theory, I see that as a loan. This is why we want to let them know, or want them to let us know, how are you going to pay us back? Because if they don't have a good answer to that, you need to be real careful about why you're giving them money.
Right.
And this is why the fear of missing out guys, the tech hype, the AI boom, the crypto boom is all like, it's surreal for me to watch. Because if you look at our numbers, they're pretty darn good. They're just not like millionaire overnight status numbers. So in the same way, if we want to compare that to like what a private person does, I can be really brief on this. Everybody knows how this works. I don't know. I don't know, man. I don't know if I can. Brian's going to time me. So if you're going to buy a house or a car, or you don't have the money, you're going to go to the bank, and the bank is going to evaluate your finances, and they're going to say, hey, can you actually afford to buy this house? Usually they like it not to be above 28% of your gross value. I won't get into any of that, your gross income rather. If you fail that test, they're not going to give you a loan. When we buy stocks, they need to pass the test. And if they do not pass that test, we don't look at it. So this is why, and we didn't plan on this. This was, we signed up for Seeking Health. They're one of our partners. We get people discounts. If you go to our site on YouTube and click on the link, there's a good link there. We can get discounts on their products. This is why when we connect our portfolio and you look at the profitability grade here, unintentionally, the very thesis that we're telling everybody of, hey, you need to be able to pay us back, actually shows up. They're all A's except for Rumble. Sorry, Rumble.
Rumble is our angel investor play.
Rumble is, please save us from the Zerg hive culture.
We want them to do well. We want them to get more profitable, but we use dividends to pay for that anyway. So if it like crashes and burns, we'll be sad for Rumble, but we won't be too hurt by it.
It'll be sad for us too. We got people watching on Rumble. So that said, getting into the stocks themselves, like I said, with all of the stocks that are here, we're buying the ones that are doing poorly by comparison. Campbell Soup is the one that we wanted to look at first. We've got ADP. Of course, Rumble's still on the list. They're going up today. United Health was another one.
It's the roller coaster that is Rumble.
It is. It goes everywhere all the time. We've got Kimberly-Clark, we got Pfizer, and then American States and Water. Now, we could get into like an Alley Capital, UPS, Procter & Gamble, and Devon. We also have to pay attention to how much we bought these stocks for. So, like, how much money do we spend? What I originally wanted to do was Kimberly-Clark. We can go up to about $8,000 before we start hitting into Intel territory. So I have to be real careful. The other thing that I wanted to do is I wanted to get a stock that pays a qualified dividend. The difference between a qualified dividend and a ordinary income dividend is, again, very brief. Ordinary income dividends you pay taxes on as it was a normal job. Qualified dividends you pay capital gains rates, and you can make 92 some odd, I think 92,600 ish in qualified dividends before you have to start paying taxes on them. So this is income on after-tax money. It's one of the few ways that you can actually make money without having Uncle Sam jump in there and go, oh, look, I want more $500 toilet flush handles. Not even the toilet. You don't even get the toilet anymore. You just get the handle. But, yeah, so I want to look. Let's just do a quick look at Kimberly-Clark and Campbell Soup. So, Campbell Soup, they've been restructuring for a few years, and they still haven't gotten there yet.
No.
And the latest fiasco with the whole thing of fake chicken and manufactured meat or whatever, which that's not the case, really beat up the stock. And I see that as a good thing for somebody who wants to buy it. And as far as their dividend goes, we're on the dividend chart of Schwab.
There's growth, but not a lot.
Yeah, you can see the restructuring right here. From 2021 to 2024, you still got your dividend, but it basically went flat. And this chart behind it is basically the stock price amidst all of that.
Now, keep in mind, they already have a high dividend. It was almost 6%. So
Yeah, yes, they do. It is 5.79. And what we like to see is, so there's a couple ratios here. There's a payout ratio, then the TTM means trailing 12 months. So that's how much of their earnings are they paying, or how much of their profit are they paying in dividends. So what we like to see is no more than about 40%.
They're a little above that.
A little above that. It depends on the industry. Some industries are higher than others. And right now, Campbell's is, I keep saying Kimberly, Campbell's is 80.8, which is really high. That means that of all of their earnings, they only have 20%, just under 20% left of their profit to reinvest in this big restructuring deal that they're doing.
Right.
Now, we're talking probably billions of dollars, so that's still quite a bit, but at the same time, there's not much left over. Same thing with the coverage ratio. We want to make sure that their cash, how much money they have to be able to pay you passively, is available. And they do have a little bit. I like to see this at over 200% typically. Somewhere between 200 and 300%. So they're not there. The numbers do look a little bit better. And if we go back to more nerdy numbers, if we go to the statements, and I'll be quick with this stuff because we don't have a lot of time today. I got to get through some paperwork and accounting later today. But what
They
I
don't
want,
care about that.
they don't care. Well, I know they don't care. I care. I got stuff to do, man. Which should highlight the brilliance of this investing strategy.
Exactly.
We're going to look at the quarterly statement for these guys, and what we want to see, total assets, we want them to be going up, and they're not. They're going down.
Now, if their liabilities are going down more, they're going down, but
I don't think
about the same rate.
that's a little bit less, just because of the size of the numbers.
Yep.
So that's not good. How about the shares? Now, this is a sign of financial responsibility. Total common shares outstanding.
Not going up.
Not going down either, but
No.
they've kept it pretty flat, and that's okay. So if we go over to the income statement, we want to look at, everybody looks at this revenue number. It's like, no, you don't care about the revenue. What you care about is their operating income, how much they make from simply existing. Most people, that's a flat zero. you make nothing. You exist, you make nothing. That is down, but this is quarterly, so these numbers are cyclical, especially in consumer goods based on food prices and everything.
That's still $336 billion. Million dollars.
Net income 194. So nothing here that looks. I mean, what is going on here? Yeah, I'm not seeing anything that looks like it's a big deal. And this is what's fascinating to me as a nerdy numbers investing finance math guy who would probably die in the event of an apocalypse with zombies because I couldn't fight them off. I'd be trying to show them spreadsheets. But look at this number. Did you know that you guys increased in population 1.96% in the last month? Zombies like, hey.
They just eat you. You become a zombie yourself.
Be a finance zombie. They'd all report to me. So anyways, yeah, they're still bleeding cash. Still bleeding cash. Let's look at the annual numbers. I'm not seeing a whole lot here, and we should probably also look at their reports. They come out with these quarterly reports. We'll go narrow it down based on these numbers and go look at probably 2 quarterly reports. I have an idea of what they'll be, which 2 companies they'll be. I don't want to say it yet because I'm not sure. Man, that was a bad year for them.
They spent a lot of money.
They did. That was their...
They had a lot of money to spend.
But where did they end up with? They ended up with like 69, and then they ended up going to 132. So it's trending the right way for the most part. And you don't want to see a business that has too much cash, because then inflation just destroys whatever's left. Let's go to income statement, see what we got here for these guys. Operating expenses are, well, they're up a lot. Yeah, this is not going the right way.
Income's going down, expenses going up.
That's like me. They're running like me. Don't do that. Yeah, their net income too. Would I sell them? Not yet. I still believe in Campbell's soup.
They're still giving us dividends.
Don't kill the goldfish or the chunky clam chowder soup, please. I like that stuff.
It's about the only thing you could eat these days.
It's like Naruto eating the ramen noodles still. He's like the top dude at this Hokage office. He's still eating ramen. That's me. I eat ramen. So no to Campbell's soup. I do eat broth. Not by choice though. I am on and off the broth diet now, to answer your question. Thank you for asking. It's it depends on the day. I'm having like relapses and good things, and doctors say, no, you have to go to the gym now. And usually that was like me trying to go to the gym to be impressive for the ladies, and I would always fail somehow without, like, despite my best efforts, I would never look like the guys who don't actually go to the gym but somehow look really strong. So
genetics.
Yeah, it goes back and forth. So Campbell's is not a play, I think. I don't think they're a play because we look at what we got here. We got Intel is number 1, Kimberly-Clark is number 2, Campbell's is still in the top 5, so we can't really jump more into them. Okay, let's go back down to the list. What's next on here? ADP. During tax time? Buy ADP during tax time? I don't think I've ever bought them during tax time. Look how bad they've done in the past. Look at that. What is it? What's going on with ADP? What happened to ADP? What happened to you guys?
It was not a great time for them.
It was not. Whoa, I don't need that much chart.
Is that max?
That is. That's a lot.
Going back to 1912. I don't know when they're...
Oh, they did. They dropped. They had bad few months. Oh, that actually makes sense to me because they were pretty high up on our list before.
They were.
Oh, okay. 30%. So is that what that is? Something like that?
Yeah.
That one, so from an opportunity standpoint, the ADP is one of the largest payroll processing providers, or if not the largest, in the United States. So they do payroll for everyone.
No, Market Edge says avoid.
No, that means we got to buy it.
That means we got to buy
it. Because they don't like it. All right, let's check their dividends out. Let's see if they can pay it. BOF, Bank of France. Big open field.
Big old fart.
What is BOF?
I don't know. Let me look it up.
That's one I don't know. Payout ratio for ADP, 60%. Dividend coverage ratio, 164%. That's pretty healthy. Okay. Let's go look at their, let's see what we got in their statements here. Let's make numbers fun. It's kind of, maybe we should play like a video game or something while we're going through this so people can like have something to look at other than little numbers. What are they?
Branch Out Food.
Branch Out Food. Oh, we have been looking for, we looked at Ingredion and a few of the other ones. We have been looking at food stocks. We'll take a look at them in a second.
Dang. 2024, they went down to 60 cents.
What were they at before?
Looks like they were at 205, dropped down to 60 cents.
205 or $2?
$2.05.
Oh, okay.
And now they're back up to 396. Slow climb since 2024.
Uphill both ways in the snow.
Yep.
Excellent. Total liabilities 10%. Total assets up.
Guess what their market cap is?
$100.
No.
Come on, what is it? Well, don't tell me. I'll pull them up here next. They are decreasing their common shares outstanding, so that looks pretty good for ADP. So ADP has a benefit of their assets going up and their liabilities kind of staying flat. Their outstanding shares are decreasing, which is really good. Operating income is going up. Operating expenses actually going up more. So, okay. I'm going to blame inflation. Net income.
Up.
Yep. Cash. It's always depressing when I look at how much cash these companies throw around.
$10 billion.
Almost. Right here, 10 billion here. So they started, what is this, annual? I got annual? Yeah, okay. So they started back with 7 billion and now they're down to 5. They bled through some stuff. We'd want to know why they did that.
Yeah.
Spending through money doesn't necessarily mean it's a bad thing. So I don't know. There's nothing really exciting about these guys right now.
Is there ever?
It's probably a good thing that there isn't.
It's accounting, man. How is that? HR. How is that exciting?
It's like our channel. There's nothing to talk about. No, there's how much do we have in these guys?
6,000?
6,000? Let's go look. ADP. There we go. We have 6,000. Okay. All right. Well, you want to look at BOF, so we'll look at BOF.
This is another Rumble.
They're branching out.
Branch Out Foods.
This is like, you look at the ticker symbol here. This is the FOMO guys right here. This is all the day traders. Ooh, buy signal. Fear and Greed Index. Branch Out Food Inc. Oh, do you want to read this? You want to read this?
I'll read it. Branch Out Food Incorporated, together with its subsidiaries, develops, markets, sells, and distributes plant-based dehydrated fruit and vegetable snacks and powders in the United States and Latin America. The company offers dehydrated fruit and vegetable-based snacks, including avocado chips, chewy banana bites, pineapple chips, Brussels sprout Brussels sprout
chips.
bell pepper crisps, and sweet potato sticks.
Who would eat that?
Private label products comprising prunes, carrots, Brussels sprouts, and raisins, and industrial ingredients such as banana, mango, blueberry, pineapple, cherry, tomato, avocado, and other products. It sells its products to big box retail consumers, as well as through its online platform. It was formerly known as Avalove LLC and changed its name to Branch Out Foods in November 2021.
So basically what that means is our marketing campaign sucks. We need to raise more money, so let's rebrand.
Yeah.
Is that what? Is that right? Is that right? Is that pretty close?
Or they did something, and they don't want to be associated with Avolov anymore. $56 million is their market cap.
Whoa, that's tiny. Tiny. This is really tiny. I'm gonna say no based on the market cap alone. Now, unless you're worth like a ton of money. If you want this to be a Rumble play, maybe. But when you're this size, I mean, you're bleeding into like a local mom and pop shop size company.
You're really, really hoping it takes it off from $3 and goes up to $20 or $50.
That doesn't happen in the food industry, though.
No, unless they're growing or have some sort of revolutionary product in the food space, that's not going to happen.
No,
I think the best thing you could hope for is that they get bought out by a bigger company.
and that's probably the most likely scenario. Any company, even at my own IT company, I get calls almost every day from some big venture capitals like, "Hey, you looking at selling your business and tired of working 80-hour weeks?" Like, well, yeah, I'm tired of working 8-hour weeks, but no, I don't think you think my $100 business is worth $10 million. So no. The food industry is, and this is kind of why we've been dancing around this for, it's like 3 years, the whole time the channel's been around, just because it's very highly regulated. There's a lot of stipulations to get that product on the shelf and actually have that product make a decent amount of money. And even when you do,
that can't be right.
Coffee Holdings, 10% dividend yield? That makes sense to me. It's the fuel, man. You need coffee. If you want your workers productive, you hype them up on caffeine, and then they probably die when they're like 40-something because they have a heart attack from the caffeine. But hey,
I don't know, man.
You got a good 20 years out of them, right?
Doesn't seem right.
Well, of course not.
Seems fishy, man. That's all I'm saying.
What's that one? That's JVA. I will not be distracted by Brian's prowess. I will be strong sell. Everybody's a sell. Nobody likes these guys. None of them. Not any of their competitors either.
Okay, would you short these guys?
Oh, do I want to get into like short float and days to cover and how that works?
Look at EPS.
What?
The historical earnings.
Hey, that's better than Rumble.
They beat it. That is better than Rumble.
It is better than Rumble.
They beat their negative earnings. They thought they'd lose more. Okay,
so for reference, I run an IT company, and this one is about 4.5 times the size of my private company. So I don't.
That's hard.
Yeah, I don't see this as a. If you've got venture capital money, maybe.
Yeah.
Maybe. But be careful with your venture capital money when you try to buy this stuff. This is a highly regulated industry. So if you're looking at NVIDIA type gains, you will never see it. Not out of this.
Classified in 2021. That was probably when they. That's when they
rebranded. Yeah. Total assets. I am curious to see how good they are with managing what they do have. So total current assets, they got about $5 million of stuff. They believe that they have $13 million of total assets, and their total liabilities. Whoa, this is okay. So there's a big difference. My company has 0 liabilities except for me. I'm a pretty big liability.
You are
to
a
my
liability. Just your mouth. Your mouth is the biggest liability.
Yeah.
And the words that come out of it.
Frequently, on a regular basis. Total liabilities. Hey, I kept my mouth shut last week. I was pretty good. I was good. That's good for me. 1050.
I want to know what these guys are actually doing.
They make Brussels sprout
I know they make
chips.
Brussels crisps.
Crisps.
I know they make those, but I want to see what they're doing to promote it, what contracts they're getting, and all that stuff.
Can you imagine the commercial for that? Come on, kids, try those Brussels sprout crisps. Yay! Okay, thanks, Mom.
It sounds gross, but maybe it's okay. I don't know.
I can't imagine that like the kid would just sit there and bite into this dehydrated Brussels sprout with that nasty crunching sound.
It's like a chip, It's a crisp.
Like, that was good, Mom. No, they did.
Who'd have thought potato chips? Potatoes would taste good in that form,
the Daddy Daycare movie from the was it the 90s, early 2000s, where like they try to sell Veggios or something and it doesn't work. That's how I see this. But they make other products. I'm not ragging on just the brother. It's a good
Right.
idea if they taste good, but
Yeah.
I don't know, man.
Get your veggies in chip form.
Probably some kid ended up making them a throwing star. Oh, look at the cash from operations. They're not profitable.
So, Jacob, what do you think about this company? You're the one who brought it up. You've obviously been looking at them, so I'm hoping we're not like crushing your spirit here.
Yeah, sorry, dude. Their cash from operations is it ain't good, and they're covering it by financing. So they want to believe that they'll eventually be profitable. This is like the Doroni thing.
Yeah.
Like they're trying to raise capital to turn that corner, and
I say if you believe in this company, regardless what the numbers say, if you believe in this company and you want it to succeed, so you want to invest into it, then I say go ahead, but only do it with money that you can afford to lose, like gambling, right? If you're getting dividends, you got $300 worth of dividends coming in that month, you want to put that into this, go for it. But if you only have $10,000 to your name and you want to put $7,000 in it in YOLO, no. Agree? No? Am I off base?
I'm still on the Brussels sprout chips,
Brussels
man.
sprout.
I'm still trying to figure that
You
one out.
cannot get past that. can
I
you?
cannot. I'm going to be thinking about that all day. So somebody, and they built a $10 million business off of this. Like, what am I doing wrong? Like, there's the Pet Rock guys. You got Brussels sprout chips, Pet Rock guys. You got NFTs selling to Justin Bieber, bananas pasted to walls.
But the Pet Rock guy made millions.
Exactly. And the guy who put the banana with a piece of tape to the wall.
He made millions just on that one.
I mean, they don't tell you this stuff in school. They don't tell you that this is
No.
how it actually works. You will be replaced with somebody who tapes a banana to the wall.
Well, hopefully that helps out, Jacob. Valley, is that Kathy Woods fund, ARC?
ARCC. Oh, well, goodness.
Or is that different?
We'll take a look at them.
ARC-X and all that?
I'll take a look at them next. I'm going to look at Rumble next, or first, and then we'll look at that one. I want to just check in on Rumble and see how our buddies over
ARC
at
is
the
Ares Capital.
Ares Capital. That is
That's
that's a fund. Okay. Is that an ETF or? It is.
Equity, yeah.
Yeah, it's okay. ETFs aren't typically bad, but we'll take a look at them. Rumble does not pay a dividend. Come on, Rumble. If you're not going to do that, at least sponsors. Hey, check this out. Their numbers are looking better.
They are. They keep going in the right direction.
They are. Yeah. So, somebody asked me once, Tom, when is this AI bubble going to pop? And you said this, that every time somebody gets paid, if they have a 401k or they buy an index fund, then if that company's on the right exchange, they will just naturally get an influx of some cash.
Right.
So small businesses like this one that are listed on the public index fund, every time somebody gets a 401k deposit, is probably what I should be saying, they're going to get money. And this is hundreds of millions of people doing this across multiple countries. So I would say the chances of a publicly issued company that is trending the right way to fully go bankrupt is lessened by that simple fact. It's not, and not just the fact that the Fed's job is to manage a healthy level of inflation. It's got more to do with just how the markets work in general. So the fact that Rumble is going the right way is actually kind of encouraging to me.
And again, we say this all the time. Keep in mind that they are not just a streaming video platform. They have data centers. They have an AI company that they bought. They have other things, other lines in the water to get revenue streams.
Yeah, like gambling. I mean, crypto. Sorry. Too soon?
Yeah, but they gave them $700 or $700 million. So
They did, so I can't complain.
I still haven't found that. I can't find in their balance sheets where that money actually went.
That's a boat somewhere in
It's
Florida.
a boat. They got a yacht.
Big old boat. Data center boat. That's good. Q4 earnings 0.09, 0.06, 0.04. So this is exactly what we were hoping for in terms of what they're able to do. Let's take a quick look at their quarterly statements for Rumble. Now, if you don't know how Rumble started, it's because they got tired of the Zerg hive mind of YouTube. And no offense to YouTube, that is a thing.
Basically, yeah.
And they started their own system called Rumble. And this is what we're looking at.
Yeah. I think it was Dave Rubin and a couple YouTubers got together and made a competing platform.
Yeah, they don't like the censor bot and the hammer that came down, curating and dictating what they wanted everybody to see. It wasn't a free market system. It still isn't. That's why we hardly get out anywhere on YouTube. Total assets, they are going up, but this is also funding. People giving them stuff. Their total debt, bada bang.
Crazy.
They're doing pretty good that way.
That's where that $700 million went. Pay off all their debt.
It doesn't show it.
It doesn't, though.
What about their shares? Total shares outstanding. So, yeah, they're still bleeding into more shares, so that's not...
Yeah.
I would expect that for such a small company.
Yeah, small company, and they're still relatively new, right? They're still trying to get past that 5-year mark of actually getting profitable.
Is this quarterly? Yeah, this is quarterly. So here's the problem: is this is 119? Is that million or thousands?
Millions.
Million. Yeah, geez. So we went from 119 million shares to 250 million shares on our primary issue. And remember, we talked about how the companies raise money. Here's how you're doing it. So then we go 106 million down to 96. That's a good thing. Mm-hmm. We go from 165 down to 124. That's a good thing.
They converted.
And then this one also went up. So overall, I'd say they're doing pretty good. Does Rumble have same size competitors? Not really.
Yeah, like Odyssey is kind of that size.
Odyssey?
Odyssey, yeah.
Never heard.
Odyssey, SCE. It's Dark Horse podcast is there. Brett Weinstein, a couple others, but there's a couple others that are kind of that size, but it's not nearly doing what Rumble's doing. Rumble is doing more revolutionary things.
Power Slap. They have Power Slap.
I think that's what started them off. Was Power Slap.
I still can't imagine. Like, I'm just gonna stand there and it's funny to watch. The especially when they slow motion watch the ripples on the face. That they got Power Slap. So
that's the stupidest sport ever because they're just purposely getting concussions.
They really are. Like, you see the guy sit there and you can tell he feels it, but he's just like, ugh.
It's like football players purposely just slamming their heads together, you know?
It's really well done, too. Like, they have these, like, it's just like a wrestling or a boxing
like
event.
You know?
It's like very well put together. It's kind of interesting. So, net changing cash, this Rumble is looking pretty good compared to what they were. Is this good enough for me to, like, YOLO it? No. But
if we're starting out the portfolio, God, I can't talk, and we're looking for that first stock, this would not be the first stock.
No.
Or the 5th, or the 10th, or the 12th. This is the 22nd stock.
Yeah, that's right. That's exactly right.
It's the stock that we purchase with extra money. Because one, we really want the platform to take off, and we want them to pay us back.
Did these two flip? They did. ADP and Rumble flipped. I was going up the line, and now this stuff's moving around. United Health, we just bought them. Again, every time I buy a stock, it dropped 10% first few months.
3,000 into them.
Yep. They probably haven't changed that much, but let's take a look at Vele. You wanted us to look at ARK.
Ares Capital.
Oh, no. They got a whole bunch of them. IRCC. That's why.
IRCC. There you go.
I can type.
Ares Capital.
They
invest in your destroyed dreams and sadness.
Do they really?
Yeah.
Is that what they do?
That's what it says.
All right. What do they do?
Let me read it.
Yeah.
Ares Capital Corporation is a business development company specializing in capital growth, acquisitions, recapitalization,
Mezzanine debt.
That's
Okay.
a beautiful term. Restructurings, rescue financing, and leveraging buyout transactions of middle market companies. So they're basically Richard Gere and Pretty Women, who buys companies and then tears them apart for profit.
I wonder if Randy Rua works there.
It also makes growth capital and general refinancing. Then there's a whole crapload more.
They really do.
You
Like they.
Read more. There's just a crapload of things.
Oh my
Restaurants,
gosh.
Retail,
Yeah, we don't need to say that. I like the word mezzanine.
mezzanine debt.
It's kind of like mozzarella.
Mezzanine.
Mezzanine debt. It's like the it's just fun to say.
Just like this middle platform or something. I don't know. Mezzanine. You think of the mezzanine level of a building or something, you know?
Yeah, yeah. They really do though. I mean, they capitalize on like broken dreams.
Yep.
We can put it right next to our defense contractor.
Sorry, Art. That doesn't make them bad people, I guess. They make money.
No, I mean Warren Buffett did that. He bought just. I mean, we do that too. We look for companies under stress. So I can't say that I'm any different, really. They have such a cool like drone flying around or helicopter flying around the
Yeah.
New York City. Okay. Helping businesses. See, they help. They don't take over their broken dreams. They help them by kicking out everybody who failed and replacing them with. Anyways,
It's like, okay, this part is successful. We're going to keep that. All you rest, you just got to go. You're all fired.
but I've been here for 45 years.
You're not fired. We're just going to sell you off to other companies. So hopefully they treat you nice.
Yeah, and we believe you. If you've been here for 45 years, we appreciate your service. So we're going to offer you a one-time opportunity to enjoy your retirement in an expedited fashion.
Here's a year of salary. So I know.
Bye-bye.
If you don't take it, well, then that's your only chance, and you're going to get nothing later on.
That is something they do not tell you about when you go to school. If you're, in your 20s, people in their 40s, you jobs on the line real fast.
By those people in their 20s that are coming out of college.
Yep. I've hired a few people that went through that. In fact, two of the people I hired were unemployed when we met them. They were big shots at their previous job, made too much money. They got replaced by people making a third of what they made. You can hire three people that are young and ambitious and don't know any better for the price of them.
I was enjoying my unemployment when you came to me.
I wasn't actually talking about you. I was talking about two other people. So, yeah.
I wasn't going to have to work again, but then you came to me and said, hey, I need you. I was like, ah.
Yeah, we have to show people how to make money. Brian has he has actual money. So if you need to a loan for something, just hit him up on his email.
That's not how this works. All my money is on paper.
His entire life's earnings.
It's in investments.
That's the thing I hate about. All right, so this is their ARCCs talking about what they have, but they don't really talk about so they got healthcare equipment and services, software, so they're heavy tech. And this is the industry compositions. They have commercial and professional services. That'd be like ADP and IT services or like Roto-Rooter, I guess.
Keep in mind,
would be
they don't own
services.
these companies. They just invest in them.
Yeah, this is Shark Tank
Right.
style, except with actual businesses.
Those are actual businesses.
Ivy Hill Asset Management Limited Partnership. They own that whole company. Consumer services, insurance. It's pretty well split through the rest of it.
Yeah.
Not a lot of big pharma. I'm curious what other is. So let's look at their holding. So the first one here is their what they actually hold. The remaining 588 investments compose 3/4 of what they have. So you would have to look at 588 stocks. Okay, what's the point of that? Buy an index fund. Sorry. But there's a difference between a company that does acquisitions and an index fund. The company here, when you buy, like I said earlier, when a company needs to raise capital, they'll issue shares. If you own shares that have voting rights, you get to tell that company what to do. And this is why people can often try to mimic what Warren Buffett does, but they can't do it the way he does it.
I was just going to say, if you got a problem with this, look at your mentor, Warren Buffett, and Berkshire Hathaway and all their investments.
Yeah,
They've got quite a few too.
yeah, and they run in and they just say, "Hey, this is how we're going to do it."
Yeah.
So these guys are no different.
They don't
do the
buy
same thing.
8.3% of Ivy. They buy
All of it.
53% or 83% and say, okay, this is how you're going to fix your company.
I would.
I like that remaining 588.
That's funny. I would characterize these like Elon Musk walking into X with the kitchen sink
Oh, yeah, there you go.
as like calling them, "Here's your notice."
Yeah. Bought everything and the kitchen sink.
They own Central Square. Oh, my nemesis.
Well, 0.9% of it.
Buy more, then I buy
Super
you.
Moose. I don't know what that is.
Central Square is a pretty durable business.
They are.
Okay. Notice how, and when you asked us to look at this one, notice how we didn't go into the balance sheet first.
Right.
We went here first. I want to know what they're buying.
What they do.
Yep.
Who are they?
They have, well, they're pretty spread out.
International.
They're actually more in the Midwest than they are. That makes sense.
I'll be back.
You got to go. Brian's got to go. I told too many jokes.
It's all that coffee.
Decaf coffee. He's lying.
Decaf.
All right. Let's look at a couple things we want to look at with these guys is the short interest. There's not a lot of short interest. The day takes 3 days to cover anybody that's putting shorts on these stocks. There's only 2% of the shares outstanding in shorts. There are still quite a few shares, but if you look at how many shares they have 718 million shares. This is a lot less than if we were to go look at like Rumble, for example, or a stock that's actually Intel probably be a good one. Where's Intel? Let's go look at Intel. There we go. Short interest on Intel, much lower. So there's not a lot of people shorting Intel stock right now. By comparison, if we were to look at NVIDIA, also low on NVIDIA. I'm going to try to find one that actually has short interest. Hang on. How about Target? Target have short interest? Target does not have short interest. Maybe Rumble does. Rumble's pretty heavily traded. Rumble does. Rumble has a lot of short interest. So that's good. They got a lot of people holding the bag right now on short interest. So I mean, it's a pretty good sign for Rumble stock. But basically what you're looking at is the percentage of shares outstanding, how many basically like days it takes to cover that. So those people are paying a fee for 12 days. Not a good thing. I think that as far as like what their holdings are, they seem to be pretty well diversified. For an ETF, they're a smaller compared to some of the other ones out there. Like if you were to look at them compared to SCHD or JEPI or JEPQ, they're pretty small. But I want to see if they actually share with you what they actually have.
Now we're on to the boring numbers.
Yeah, we're on to the boring
I'd leave you
numbers.
alone for 1 minute.
Boring numbers. Hey, Veli, do you know if they do covered calls with this one? I didn't see anything about that when looking at their numbers. So they think their competitors are Franklin Resources, Investco.
That's good, yeah.
I've heard of them. Evercore.
I don't want to have maybe it's somebody's last name, but stifle. I don't want to invest in somebody who stifles.
Never live that name down.
Come on, man, you're stifling me. You're stifling productivity.
I do that. That's my job. That's what I'm supposed to do. Earnings. The only red flag I'm seeing right now is their dividend yield. That's a high number. Anytime you get over 6%, even at 6%, that's a pretty risky amount to pay in a dividend, I think.
What's their payout and all that?
Yeah, we'll take a look. It did show their net profit margin at 42%, and they do acquisitions. The thing that concerns me is so this is just me kind of talking out of my rear a little bit, but when you look at a venture capitalist style business, a lot of times, even, and I've seen this in the business world all the time, when they buy a company and they come in there, sometimes they'll just sell off the company in its entirety. And when you're buying a stock, and I don't know if that's what these guys are doing, you don't want to get your dividend checks based on things like that. You want it based on products. Now, looking at their composition, I don't think that that's where a lot of their dividend checks are coming from. But again, you're only able to see the remaining, like you're looking at some of the big holdings here, and you're only able to see those compared to the 580. I mean, you have to look at 500 companies, almost 600 companies, to even have any idea, like, what are they actually doing? And I, as an investor, I don't like that. I like knowing what I'm buying, and I like knowing what they're able to do. Now, that said, there's not a whole lot of red flags. There is one that I just saw that I think we should probably talk about slightly. Look at their earnings here. The adjusted earnings. Everybody thinks these guys are going to do well, and they make big promises, and they never deliver on those promises for the last 4 quarters. Does that mean that it's going to be like that historically, or they're going through a bad run? Well, I don't know. If you look at the annual ones, you can see the same thing. Their revenue is going up, but their adjusted earnings per share is dropping. And I would contend that that probably has a lot to do with their dividend check. When you're paying a big, like, that's a big number. When you're paying that number,
Drop big too.
yeah, so you can look at the market cap of a business. When they pay their dividend, the market cap will drop by the exact amount of that dividend. Now, this is outside of people trading the stock, which kind of screws that around a bit, but that's what happens when a company pays dividend. They're taking equity out of the business. You're taking from that business to pay you. And when companies pay this high of a dividend, typically you see something called net asset depreciation. And if you look at their balance sheet before we actually look at their dividends, you'll probably see some of that, I would think. Total, but not here. Yeah, you won't see it here because they do acquisitions. That's why you would see it. Yep, here you go. That's what I'm looking for. Total shares outstanding. So they've almost doubled. Now, granted, their net assets did go up. So you went from here, you basically went up 50% on net assets. Their liabilities, they also went up close to, actually just under 50%. You go to their income statement and you take a look at them here. This probably all looks pretty normal. I would contend that they can't afford that 10% dividend though. At least not normally. Total operating expenses, yeah, so this is pretty decent. Up 50% on their expenses. Their income has doubled. That's a good sign. Their net income has gone down, though. Again, sign of too many dividends, too big. Go to cash flow. We should see some pretty violent numbers there, too. Not as violent as I expected, so that's not too bad. And that's why.
Total net issued, and they are not...
They're not paying a lot of it back either. Don't pay dividends from loans and issuing stock.
Yeah, they're issuing more debt than they're reducing it.
IEP has that problem. No offense to IEP or these guys. They probably are pretty responsible with what they have.
Well,
but
you know, for what they're reducing and paying off, it's almost equal to what they're putting out.
let's look at their dividends. Let's see if that 10% is real. This is different than a regular dividend. I want to keep this in mind. If you are paying, so qualified ordinary dividends, if you make $100 from an ETF or an RAIT, you will pay taxes on that. So your $100 dividend becomes $75 right out of the gate. If it's a qualified dividend and you're not making millions of dollars per year, that $100 is $100. So keep that in mind. A qualified dividend will pay more than an ETF. So you can make a 6 or 7% yield on a qualified dividend paying stock and match this 10% just because of taxes. Now, if you're not in the United States, that's probably way different, but I would contend that if you're not in the United States, you're going to pay more taxes. So they increased it, yeah, yep, and it's been flat. This tells us they hit a plateau or they hit their goal. And they're yep. That's exactly what I expected to see.
Flip-flopped.
They're paying 104% of their earnings in their dividend, and they are not able to cover it fully with their existing cash flow and operating income. So that is not a 10% dividend yield. If you go by these numbers, their cash flow has to double, and if we have to get it down to the 40% to 50% so they actually have money to do venture capitalism, I would say that you're going to cut that dividend close to 50%. So it's a 5 or 6% yielder. On average, you might get 6 or 7. I think they probably had a couple good acquisitions, and that's why they're paying it. I don't think this is a consistent number. So that rules ARK out. Sorry, Valley. At least for me, anyways. Good, healthy payout though, and doesn't look like a bad business. No. I mean, they've got what 600 companies that they invest in. That's almost index fund, but when you're how do I say this quickly? When you're a venture capitalist company, you start these businesses because you want control of how businesses run. The investment side and paying your investors, that can be part of it, but oftentimes the people running the business just like the idea of like helping other companies or acquiring other companies and growing their business that way. You end up with a big diversified portfolio, very similar to what like Warren Buffett, Berkshire Hathaway did. And he did a very good job of that. He helped a lot of people. Right. So maybe they could help them, but as an individual investor, you got to be real careful with like, if this is your money, if you trust these people to do a better job than you could, and maybe they could. You know, there's a good argument for that too.
And it's within your best interest to do that because you want them to make more money so you make more money on your investment.
Right. But when they're paying 104% of their earnings and dividends, how are they going to make more money?
Yeah. I would want to see all the dividend payouts to see if there was like some special payouts in there or something.
Yep. And I don't have time to go through all 600 companies in our list to analyze and say, well, are these all good businesses or not? And are we buying them at the right time? Is this one depressed relative to their earnings and all? I mean, I don't have time for that.
No, because you're relying on them to do that research, and you're giving them the respect to be able to do that. Yeah, so you don't have to.
That's a good argument for a stock like that or an ETF like that. This is why people say buy VTI, VOO, and chill, because you're paying them to do that. There is a fee. Mm-hmm. You're paying a fee for that, and they just handle it for you. And chances are, if it's an index-based type stock or ETF, you'll probably do just fine.
Yep. And this is a little different than like an index fund because you're not really paying a fee for them to manage an index fund. You're paying them in stocks to be able to do their job. Mm-hmm. And invest properly into the companies that they want to make better.
Yeah, you believe in their portfolio of businesses that they've acquired that they can raise additional capital and
just like Berkshire,
and make money. Yep. And it could. And chances are, because they have a board, because they're public, because they have shareholders, they probably will.
I want to see who's heading it up and what kind of Warren Buffett type guy is maybe the leader of all this, you know?
Yeah, pay attention to how much they pay their executive teams, what kind of compensation packages they have, like vacations, do they have big extravagant homes? Make sure this isn't like a Black Lives Matter movement where you find the major people who started that movement buy these $10 million homes with all the money they gave them and they get sent to court and jail for the corruption. So none of that. Am I saying these guys are doing it? I have no idea. I don't think they are, but pay attention to it because that's also in there. This one,
our friends at United Health.
Yeah, they've had a bad run lately, which is probably good for people buying. Yeah, they're just kind of sitting, farting around at their low still.
Went down. But we knew, I mean, they had some issues.
They did. Let's look at their dividends.
because they're still a good company. They still make a shit ton of money. So it's not like they're a bad company, but they've had a poor run of things the last 2 years, especially since when their CEO is unalived, as they say.
Now, when Brian says good, he's referring to profit structure. Maybe not ethically.
But look at their payout. Payout's 49%. Their dividend coverage ratio is 203. It's what we want to see. It's within our parameters. So, I mean, there's a lot of good still in this company.
Yeah, and there's a chance for when they do their vote on the shareholders and they do the board, you can tell them, hey, stop doing the bad things. That's if you want to fix corporate America, that's how you do it.
Yep.
You invest, you vote, you sit on the board, you work there. You can't make a difference just like throwing a sign up in front of the building. Like that's not going to do anything. Owning shares in the company, that would actually do something. So
now we should do, if you scroll down, we should do a whole video on CVS.
Really?
Yeah.
What's going on with CVS?
They're in the news. They have been purchasing companies. So they have CVS Pharmacy. They have Aetna for insurance. They have the pharmaceutical company. So you could do your entire health care just within the CVS,
just with CVS
companies that they own.
Really?
So the government's having some hearings saying, okay, is this a good thing? Why should you have this kind of monopoly over the total health care?
Oh, and Microsoft's okay.
Right.
Google and Microsoft are fine.
So that might be an interesting one to look at some point. Because when I started looking at that, I was like, oh my God, the companies they own, they could just price fix everything.
They really could.
Yeah.
They really could.
Like the insurance company that they'd use to lower the cost of the things that you use from CVS, for CVS, by CVS. It's like...
Sponsored by Pfizer.
Yeah. So there's the big chance that they could just fix all the pricing.
I wonder how long they'd get away with that. Kind of like the whole JP Morgan Chase thing where they got slapped on the wrist for manipulating the markets and they still walked away with $10 billion or something like that.
How much did you make? 100 billion? We'll charge you $1 billion.
I mean, even the attorney fees and everything after that, they still did. I mean, I don't think they're sorry. I mean, after 10 billion,
that was a profitable venture for them. I think CVS would have to keep the prices comparable to like Pfizer and them. Maybe just a little bit above, but comparable.
We'll have to look at them.
Yeah.
That might be I think that's a good idea.
Not saying that they're doing price fixing, but they sure have an environment that could facilitate it.
I can see some guys sitting behind the board meeting. Yes, there's only one left. And then we run it all.
And then we buy Pfizer.
Yeah, Pfizer's not doing too good lately, so they might.
And then we'll own it all.
But Pfizer's massive.
One company to rule them all.
Pfizer is massive. It'd be hard. Oh, look at that. Oh, okay. Quarterly. I need to look at them quarterly. This is United Health. While Brian and I are talking, we're looking at United Health.
They spent some money.
They have been, yeah.
But they got a crap load of money. So
almost too much.
you got to spend it on something, right?
$24 billion.
Yeah.
What about their shares? Are they buying back shares? They are. No, they kind of are.
No. Well, it went down a little. It's going in the right direction.
Man, healthcare is profitable. Holy cow.
It is.
Not in a good way.
It's sad. Did I tell you what my surgery was?
I almost don't want to know. How much was it?
$27,000.
Oh my gosh.
For my ACL surgery. That's not what I pay, of course, because I have insurance. Thank you. But I got a bill for $27,000
So
for 4 hours of work.
Thought experiment. What do you think is going to happen to insurance costs if this whole Trump thing of giving the money to the people directly instead of the insurance companies? What do you think that's going to do to them? And the cost of all these surgeries?
It's got to go down. Because I think there's been a symbiotic power struggle between insurance companies and hospitals, right? The people who do it. hospitals don't want to charge $27,000, but they have to charge $27,000 because the insurance company is going to say no, it's only $6,000, and then you're going to pay $3,000 of that, right? So you're $27,000 down to $3,000 that you actually have to pay.
At the cost of the doctor's sanity.
Right. But if there weren't insurance companies and people could afford the health care, right? The health care, I think, would be at a reasonable level. Now, there are some ideas out there that, okay, you have this MRI machine that costs $10 million, right? You got to pay that off somehow. So that's where some of this cost goes into. But in research, right, that costs money. But other companies can do research and development on things and not charge 10,000% over what it should be.
I have misgivings about insurance in general, because when insurance got involved in that industry, the $27,000 surgery wasn't a thing. It was an altruistic thing, and all of a sudden, like you said, this symbiotic kind of monster started getting crept into that, and now it's just insane. If you don't have insurance, you're not, I mean, you can't afford it, but it is cheaper. Like we've
Right.
asked.
If you don't have insurance and you go to the hospital, then they have a separate pay schedule for you. It's less,
They charge you per liter of air instead of ounce.
especially if you're going to pay them cash. Like if it's not a monthly payment, if you pay them cash, it's a lot lower.
Yeah. That's my point though, is like if you take that away from the insurance industry, which is huge, I mean, the insurance industry is going to be in trouble from that, first of all, but like,
Right.
secondly, what happens to the medical industry? What happens to the cost of your prescriptions or your any of these like Pfizer and United Health and all that? So this is one of the things that, as I was looking through United Health stock and you're talking about CVS, it actually kind of made me think like, okay, that's legislation now. We're going into midterms. Midterms could affect it if they pass that. What does that actually mean for like United Health? Or any Pfizer, anyone, Johnson and Johnson or Moderna. I guess they had some sort of mRNA vaccine that got approved for the flu. They're going to modify your DNA to make you immune to flu. Yeah, but that like all of those companies would be affected by that in some way. So if you're a hospital and you had these massive numbers coming from insurance, all of a sudden that number goes to $2,700, not $27,000.
Right.
What do you do?
You're in a little bit of trouble because you're paying your doctors, paying your nurses. All these people have salaries that you can no longer afford. I think doctors should make a lot of money.
They should. They go through school for 16 years.
And you're saving my life, right? I mean, how do you put a price on that? You saved my life. So, yeah, there's a lot in there, and you're also coming to the realization that a lot of these hospitals own the insurance company, like Coral owns Priority Health, you know? So there's that. It seems like you shouldn't own
You shouldn't own the
regulatory
one
service.
performing the service.
Right. So, I mean, there's that, which is incredible.
I think, therefore I am. No, I think that that industry, because insurance does have benefits. Like there are points where I've used insurance and it's like, hey, this has really helped us.
Insurance is benefits.
Well, I'm
Part
talking
of your
like,
benefits package, right?
yeah, I'm talking like
I know,
tree
yeah.
falls on your house or something
Right.
like that.
And
So
that's what it's there for, though, right? I mean, it was there, like the automotive industry. They didn't have insurance for a long time, right? Because you paid $200 for a car, and it was just, if it wrecks, you just paid $200 for another car. But it's when people started suing people for hitting you, right? That's where the insurance comes in.
or
pay
they
off
wreck their
those.
car intentionally.
Right. And the price of automobiles went up to a price that you couldn't afford. So if you bought a $50,000 automobile, they could barely afford, and you total it, and you had to buy another. You couldn't buy another $50,000 because you still have the loan that you have to pay for that automobile in the first place, and you don't have the asset anymore to pay it off. You can't sell that to pay it off. So that's where insurance comes in to help out with all that. You pay into it to
Here's my thought process on the insurance part. What if we didn't have it?
If it never existed.
How much different would people drive, do you think? Oh, if I get in an accident, I got insurance, they'll cover it. Well, what if you don't have insurance?
If you, I would put it this way: if there wasn't insurance and you didn't have a liable law on the book that you could sue somebody, right? So if two people get into an accident, even if somebody's at fault, you couldn't sue that person. I think there would be something different, you know?
You think they would be more responsible?
Maybe.
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 Maybe. It's a good thought experiment. So I don't know if we have enough information to make a decision based on like what might pass or what might not pass in that space.
Yeah, that's like a 10-hour conversation.
It could be.
Insurance and possibilities.
It could be.
Because there's a lot of implications for that.
Whole operating. See, yeah, Kimberly Clark is, they made the acquisition and this is a toilet paper company, so we're bouncing around a little bit.
We're still looking for something to buy.
Still looking for something to buy. In case you're wondering, like we're correlating our insurance conversation to United Health stock because we own that stock. We're thinking, do we buy more? Well, what economically and what policy-wise would affect them? That's what we're talking about. So in terms of Kimberly Clark, they bought out Kenvue. Kenvue was a spinoff from Johnson & Johnson. And since they made that announcement, look at that. Here's all the internal speculation right here. This is when the insiders know. And then when they bought it and it shows up, that's where it goes. So I really wanted to buy these guys. I think I need to give them another quarter.
Yeah. Market Edge says, meh.
And this is kind of why. That would be kind of why I think it might not be time for them. But we've done this before, and it's always worked out pretty good. And
right.
Let's go to the next one, because the other one on the list I wanted to really take a look at was Pfizer. This is the last one I wanted to look at today. So Pfizer is the one that AI told us that this one is the one to turn around, and it gave some pretty good reasons for it. Said that the narrative was kind of south on it, that they're in the middle of the recovery from the COVID boom, and like the numbers, it's a value mismatch is the way it played it. And if we look at these guys,
let's bring that out a little bit.
Yeah, that's not enough time. Let's do 5 years. 5 years. Yeah, you can see it.
That was their COVID high.
And if I was to look at this versus Kimberly Clark, I would put them kind of like Kimberly Clark's here. They're gonna flounder a bit while the acquisition takes a look, because acquisitions are messy at this size. When you get to that size of a company, it never is smooth. I've never seen it smooth. And this is working in the IT side of the mergers for 20 years. Yeah. It's never gone well.
Well, think about these guys. They bought out a lot of their competition. Like Upjohn was big in Kalamazoo.
They were.
Pharmacia bought them out. Pfizer bought Pharmacia. So it's like a big fish eats a bigger fish, eats a bigger fish. There's always a bigger fish, right?
Yes, there is. Their short interest isn't too long. 150. So when we talked about the ETF, that was a $13 billion ETF. This is this is 10 times, more than 10 times the size of that. So if you're looking at like, how much more is this stock going to go up? This stock isn't going to go up as much as like that little tiny food processing company could. The food processing company could explode and be worth the thousands of times more percent.
Right.
Whereas this one, you might go up to 200 billion, maybe 250 billion, because demographics of how many people exist that they service play a part.
A lot of products. They would have to come up with like the cure for cancer or something.
Yeah. There's actually some cures for that people are saying that are coming pretty close with this AI helping.
They'll buy it out and shelve it.
I
Come
hope.
up with a treatment.
I hope not. I hope not. 6.4%.
Look, it go up every year.
Yeah, see, this
2%,
looks
2%, 2%.
this looks like a good comparison between here and United Health. We're at 63.14% for Pfizer with 1.5% or 1.5 times coverage. And if you look at United Health, make sure this comes up right. Granted, the dividend is half the size.
49 and 203.
The numbers look better.
Better.
So you got some more safety for United Health.
Look at how much their dividend is going up every year versus Pfizer.
Yeah.
Pfizer's growth is like 2% every year, which is good. It's going up. But man, United Health is just,
They're killing
they're
it.
catching up.
Yeah. And this one's even bigger. This is 200. Look at the size of that company. I get surprised by looking at the size of the company every single time. I was like, oh wow, they're really big.
And then you're looking at NVIDIA at 4.7 trillion. Like, oh.
That I still don't see it. I don't see that market cap. I don't get that.
That isn't so big after all.
I mean, they got to do something with the money. They'll probably be buying a bunch of businesses. So it's really, Kimberly Clark's not there yet. I would say they will be, but not yet. So for me, the real play here is Rumble's improving numbers, United Healthcare's growth from the 3% versus Pfizer's value play. And if I look at the numbers that we have in each one of them, it's 6,000
3,000.
for 3,000 for 3,500. What are you thinking based on what you see here? He doesn't know.
I'm contemplating because my first gut instinct is put the majority into United Health, put a little bit into Pfizer, a little bit into Rumble. But on the other hand, if we don't put into Pfizer, then we just take the Pfizer amount, put that into Rumble.
2 days of short interest on Pfizer. We've got how many short interest on United Health? Let's go take a look at them real quick. Oh, they're fulfilling their shorts.
They are. Look at that.
They are. Okay. And Rumble's got a massive short interest. What?
It's,
This is day
it's all
trader's
Google.
dream.
It's all Google. Google's shorting them. Yeah, that's massive right there.
That's good. To be that long is good, but when you look at the percentage, that's like of the shares that are outstanding, that's not necessarily so good.
Yeah.
Now, this is a good sign when the short interest takes 11 days to cover a month ago, and that's 12 days as of today. That basically means that the stock, the earnings, the way the market is treating the stock is not necessarily as fair based on the way that their book value is starting to bounce back.
Yeah.
And we covered Rumble a while ago if you're just tuning in. So you're thinking,
My gut's telling me United Healthcare.
we're going to have a few months in a row in United Health.
We've had a few months in a row in Intel too.
We did. It was like 6 months of nonstop Intel.
And look what happened, right? So
I don't think that'll happen to these guys.
not to that
Intel.
level, no, because they're not hurting as bad as Intel was.
No, and they're massive. I mean, this is a $262 billion company. Intel was all the way down to like 10% of what they once were.
Intel was one of those maybe once a year, once every couple years type of opportunity.
Yeah, those are one of those stocks that I will buy. I usually buy like $40,000-$50,000. That one I bought a lot of, about 65,000, I think, of Intel,
Yeah,
and they tripled almost.
I bought it for my daughter too. I put it in
Did
my
you?
portfolio. Yeah,
Yeah, so I bought a ton of that stock, and when they doubled, I sold a bunch, and I guess I bought a tractor. I still have Intel. We still have Intel here, but I still think this one's got room to run. This one still has legs, I think. But I don't know. I can see the AI argument for Pfizer. I can see what it's saying. If you look at the trailing PE ratio and you look at like how they're doing as a business, I really do understand the dividend yield play there. Brian, your mic is pretty quiet. Oh, nobody told us that before.
How's
Hang
that?
on.
Is that better?
Let me turn them up.
I was talking a little quiet too.
There you go. Now you can hear Brian's beautiful voice even better. Oh, so now you don't talk?
No, I'm not gonna talk.
Now he's going to say anything.
Honestly, I think between Pfizer and United Healthcare, it's 6 to 1, half dozen the other. I think we'll do okay with either.
Yeah, but one's got a 6% dividend yield.
Yeah,
That's qualified dividends
it
too.
is. Look at that growth.
So let's do some like math for a minute. If we were getting $100 in dividend checks from, let's say, this stock, the other stock's half that, so the other stock would be $50. So this one's going to pay us $100. If it goes up 2% next year, it's $102. If we go and turn that around and we look at United Health, that would be a $50 dividend check. Thanks for letting us know, by the way.
Absolutely.
It's Brian's first time back, like in person. So, you know, us old guys in technology, how that works.
Able to drive again. We're at 3% to that. Yep.
3%. Where are we going?
Right there.
There. Okay, so yeah, this would be a $50 dividend, but they're going up.
Double digits percents.
It's slowing down, but it's still, and they still have some room to grow.
They do.
I wouldn't say too much room. So the question really is, if I'm going to go up 10% year over year on United Health, and I'm going to go up 2% on Johnson & Johnson, so I'm 102 next year, 104 and 20 cents the next year after that, 106 and
Pfizer.
60 cents on Pfizer. Yeah, United Health would be 50, and then 55, and then 60, and then 65, 70. I'm actually leaning more towards
Pfizer.
Pfizer in that scenario.
And here's another thing to look at. $286 per share for United Health and $26 for Pfizer. So we're able to buy more shares into Pfizer to get more dividends anyway.
So Mardo Chaos, I don't know how to say your name. You joined us late, man.
We started early.
We did. We started early this time. You can rewind and hear my beautiful voice and Brian's quiet little, tiny little timid whisper after we're done.
Timid Wister. It might not be that bad in the beginning. I don't know.
I'm leaning towards Pfizer
Let's do Pfizer.
and Rumble.
Pfizer and Rumble.
Brian's mic didn't seem quiet on my end. I'm watching him. Yeah, it's because Rumble's better than YouTube. How about that?
See?
Let's see.
That's why we invested in Rumble and not YouTube.
Ouch. Don't tell YouTube that. They're going to I just got canceled. This is kind of like the Y-Files when the fish criticizes the algorithm every other episode.
That's true. That's true.
This is why the
Sorry,
algorithm hates
YouTube.
us.
I just get scared sometimes.
Yeah.
I love you, YouTube.
I do like their AI telling us that we suck every time I ask it a question.
I get scared of being alone.
So why is our channel not growing? Well, because you guys suck. Oh, okay.
Well, thank you. That's very
Thank you.
unconstructive.
What do we do? Make better videos. Oh, but we're not getting paid. So how do we do that exactly?
Make videos people want to watch.
I think this month it's going to be Pfizer.
Pfizer. I like it.
You like it? I should buy
Yep.
Pfizer. Anybody disagree with that? Tell us now, or just
Forever hold your peace.
deal with it. We're not really. There's not a lot of other places for us to go. We might have to add a stock to this portfolio soon. I'd have to like completely liquidate Honda and then Fifth Third, I think.
Yeah, I think we're at that point.
You know, I mean,
We saw it. You don't have to do it now.
I kind of think I want to. It's up 112%. I mean, that's like $2. I mean,
Cost basis is $24.
I mean,
It's up
$2.
$52.
At my tax bracket, I will take, yeah, so I mean, it's $2. So I make $24, and then the government takes 22 of it, and I get 2. I can almost buy a gallon of milk.
That's how much this cup of coffee cost.
That's probably true. All right, I'll do that. I'm going to sell Fifth Third, which means that opens us up for next month to look for banks, because we can look at banks again.
Yep.
And then we will look at, because that's an unrealistic for a bank, especially a bank that
Well,
size.
it got bought out.
Yep. And then we'll probably liquidate Honda so I don't get that foreign company
Foreign
fee.
tax.
So that opens us up to an automotive company. We could look at banks and automotive companies with that knowledge. So let's do that. Let's sell all shares, all one share.
We could buy Tesla then.
So the lesson learned on no.
That took a minute.
It did take a minute. I was processing. I was like, "What did he just say?" Well, maybe we could buy Tesla. I don't know. We'll look at them too, I guess.
Where are they at?
The lesson learned on Honda was that we were right. The tariffs did play a part. We do think that that's still a thing, and I don't care about the limits or anything, so we're just going to sell it.
We made money on it. We sold it.
Yeah, we did. We sold Honda when they were almost 50%. It was like 46% up. You can go back. This is the one share we were fact checking ourselves just to see.
We sold at a good time for Honda.
Yeah, if it
we
was-
sold at a
if you're
terrible
right.
time for Comerica.
We really did. I kind of
We
regret
still made
that.
money on Comerica. It's not that we didn't make money. It's just
Yeah, we made 42% on
something
that
like
one.
that. 40,
Yeah, 40.
somewhere between 40 and 50. We could have made 100, 110.
We could have. That's why I kind of like when Intel goes up like that. I didn't want to sell them, but man, I need to buy stuff, so it's
Right.
like, I could have made more money, but whatever.
See, I just don't buy the stuff.
Yeah, that's why you're probably worth more than me.
Keep
But
it in there. No, you're still worth more.
but I have a tractor. I'm a tractor boy, Brian.
On your farm here, that
On my suburban
your quarter acre
association, it's an acre and a half.
that you
ish.
can't use because there's trees all over it.
I'll just knock over the trees.
Because that's safe, just knocking over giant beech trees.
They're 300 feet tall.
You're going to, like, put it into your neighbor's house and they'll sue you.
You know, my neighbor, when he saw it, he came over, was like, so, are you renting that? I'm like,
Are you moving?
no, I'm not renting that. It's my tractor. He's like, that is so cool. He's like getting in the cab. He's like, I'll pay you to plow my driveway.
Like, you could use it. You could buy one yourself. You're rich. These rich people over where you live.
Yeah, they're all old.
So,
Old people.
they could sell it. Sell it. What are you selling? Make sure you're selling the right thing.
I don't want to sell 3M, so I got
Is that Fitbit? Oh.
Fitbit. Somebody at the bank watching right now saying, hey, how dare you compare us to Fitbit? We're an institution, Brian.
We've been around for decades.
They have been. They were, what were they? What did they buy out here in West Michigan? There was a bank, Old Kent.
The Old Kent.
I think they bought an Old Kent bank.
Yep.
Yep.
They bought out Old Kent.
All right, so we're selling Fifth Third Bank Corp. Watch how fast this one fills. Boom.
One share.
There is a, in case you're wondering, there is a limit to how much, like if you're trying to sell over $100,000 of shares, it took me 3 days, I think, to sell Intel. And that was because the market was going down and Intel was kind of going down with it. The very next day, they went way up. It's like, But when you get over 100,000, and I would even say like for day trading, the limit's about 500 grand in your account. If you get over 500 grand, it becomes really difficult to fill $10,000 options, and because there's not as many people that have that to do that. So let's see if it did it. Do we have a shorter list? We do. Do we have a shorter list?
Well, it should be. Should be -2, right?
Yeah, we have a shorter list. Okay, so now we have a total of a number of stocks. I can't count. Why is it not showing me that number?
I don't think it gives you the number, right?
Oh, I'm not an E-Trade. That's why.
Yeah.
Dang it.
You gotta go to the one.
Okay,
View.
let's buy Pfizer first and Rumble. Let's buy some Rumble. How much are we buying? We're gonna buy
400.
Pfizer stock. What do we got? 6,000. How much is Intel? What do we put into Intel?
9.
Oh, we did. Did we really? We
9,400,
did.
yeah.
Wow, I'm greedy. Let's see, Pfizer. So we could put the whole position into it.
You could.
Should we?
You want to?
Kinda.
Okay.
Wow, you fought me hard. Let's not argue that at all, shall we?
I don't know if we need to argue that.
Let's see, how many shares of Rumble can we get? Rumble is
At the bottom. Oh, you.
no, they're not.
Yeah, there it is.
AT&T's at the
It's
bottom.
halfway up.
Come on, AT&T, crash so we can buy more of you.
Halfway up. Stop.
At which point Brent goes,
Down.
"What did you say?
Down. Down. Stop. There you go.
Are they 5? What are they at? They're below 6.
588. Yep.
Okay. I'm picking up what they're putting down. Look at that nice rating of F. That's like my school grades. That's perfect. Let's do that. Let's buy 400 and some odd dollars of Rumble.
481.
Because I think our dividend checks were that. Let me go look
480.
at the transactions here. Let me see the dividends. So qualified. Qualified. So 30, 20, 20, 70. Campbell Soup paid us $70.
An alley. Not qualified, but 66.
So we've got a couple $100. I don't think we can spend $400 of dividends in Rumble, but maybe 200.
Sure.
$200? Okay, let's do that. Let's do $200. We like buying completely random, obscure numbers that don't seem to make sense to anybody but ourselves. It's like our jokes. They just kind of make it sense in our head. Quantity. Can I figure out the math? I want to invest $250 in Rumble. I think our dividends were $389 last
42.
month. Yeah. Hey, look at that. Okay. Let's do that. Buy it, market, and all the short people just went, dang it. Because we completely, our total $250 completely disrupted Rumble.
Oh, yeah. Absolutely. All those short sellers, they got to fill in their shorts now. Cover it.
These are such small numbers. Like it filled. Done. All right, let's see what else we got here. We are going to Pfizer. We are sponsored. No, we're not.
We are not sponsored. We'd like to be sponsored by Pfizer.
Our channel is sponsored by nobody.
Just give us money, Pfizer.
Bank of Tom. Buy shares. How many we got left? 234. Or I'm going to say 2,200. Buy shares. Click the calculator. 2 months later. Apply. Press buttons. Market.
Review.
82 shares. Wow.
82. We got 214.
Actually, I'm going to edit that. That's I want to go up. 83. Yeah. There we go.
Why an odd number?
Because I'm odd. No, because I wanted to do $2,200.
Oh.
And that's it. There we go. How fast do you think this one will be ordered?
Instant.
Buy. Pff. We're buying. Pff.
Done.
That's so crazy.
Sucker. Buying stocks.
I remember
Easy as that.
during COVID trying to sell some stocks, and like a week later, you see it trickle in
Oh, yeah.
every few days. That was painful. I got what I thought I was going to get out of it, but it was kind of painful. All right, so what does that bring us to? That brings us to, in our account, lots of money.
$123,182.63.
Yep, we only have $28 left to invest. We'll do that next month. No, we'll have more money in there next
And that
month.
should
so.
raise our dividends a little bit to 320 maybe.
Yeah. So our biggest non-paying dividend is Intel. Our cost basis now is Intel, Pfizer, and then KMB. what does that leave us to potentially buy? Fastenal, AT&T, Coca-Cola, Anelli Capital. If Anelli Capital didn't dilute their shares so much, that 12% yield would be so juicy to me. I would really want to buy them, but
Look at Zom up 45%. Exxon.
I'd like to buy these. So really the only one left is United Healthcare and
Rumble.
maybe Chevron, because we've had Chevron forever, so that 23% is kind of like natural growth. There's not a lot of places to move inside the portfolio, so we might have to start looking for. So if you're watching, give us some stocks to look at for next month, because I think it's going to be automotive again, and then maybe some banking, because we just got rid of the last vestiges of our banking stock. We'll have to kind of pull into that sector too. I'm a little bit worried in banking because of the asset bubble. A little bit worried about the unrealized losses, which a lot of that's been kind of fixed since we talked about it in that video. So we'll have to see if there is a good play to do in banking, and if not, no big deal.
Look at Rivian.
Rivian lost $180,000 per car last year. I'm not sure I'd want to buy them. That would be one that's that's bad juju there. Maybe they're coming around. I don't know, but
That Chinese automaker that's selling more than Tesla now.
oh yeah. That we said that about Tesla when we did the video. Tesla's like, hey, how long is it going to take for these competing companies to come in and just like gobble them up? And they're starting to. That's why Elon's focusing on everything else, robots and AI and
But he
all of
always
that.
has, though. It's not like a new thing, new trend.
What are you talking about? He's consistent. He's always consistent. He never changes his ever changes his opinion on
Well,
anything.
he does, but I mean, he had the Boring Company and SpaceX and Tesla and
I'm joking.
and all these.
I was joking.
I'm just saying. Don't you talk about my boy Elon?
Really?
No,
Brian's like, I played Diablo 3 with him
It's fine.
once.
I did.
Or 4, Diablo 4. Is that a thing? Does he even play that? Or is it just like he pays some guy to do it? How do you do that? Do you go to like some college campus like, hey, do you play video games? Yeah, okay. Can I pay you like $500 an hour to play Diablo 4 and forego your entire career? Like your financial future just to play video games? So here
why
we
not?
go. Here we go.
28.
We are up to $328. So in my company, every time we hit 350, I increase our benefits by $50. We are getting close to that in this portfolio. We're pretty close. I think we will be there if Intel starts paying a dividend without doing anything else. I think we will. I don't know if Intel's going to pay a dividend this year. They're still struggling on the struggle bus, but they're coming out of it. So
Boy, if Intel does pay a dividend, I mean, that's going to go up
a lot.
considerably.
Yeah, a lot. I think they'll be like NVIDIA where they bleed it in slowly, though.
Yeah.
All right, as far as our performance goes, are we at my 20% yet? We're close. Including dividends, we're 18.
We're getting there.
About 18 and a half, 18, somewhere in that range. Okay. That's not bad. That's per year, people. Okay. I think that's what we had. We bought a stock. We did some analysis. We talked about insurance.
Yeah. Exciting insurance.
We're going to have to look at on the insurance side of things, like how this policy is going to affect that. Because if United Health is the only one left, that's us putting into Pfizer and United Health right at the behest of Trump saying that he's going to change how the whole industry is funded. So, like, if that happens, then these businesses are going to violently fluctuate. We'll have to see. I think that's all I have for today.
But we're not going to panic when that happens.
No, we don't really care.
Because we're not retiring anytime that soon.
Especially not me.
You're never retiring. I don't think you could. You could have $100 million in the bank. You'd still not retire.
It's like somebody told me about my remodel. You're going to be 85 years old. Times like, that wall needs to come out. Try to swing the hammer.
It's going to take me a while, but I'll do it.
Yeah. We're still beating them.
Yep.
Still beating them. We're finally getting there. And this is when we told people that, hey, this stuff takes time. It really does. You can't just, I don't know, you can't just like start investing and show really good returns and showing that, oh, yeah, we know how to do this and we really do know what we're doing in like a month. It takes time. Investments take time, and
Yep.
being able to showcase the knowledge takes time. So we fully understand that we're only on year, well, almost four.
Well, we're rolling into 4, aren't we?
Almost four. And we said that 5 to 7 years, that's when it would start showing up. And sure enough, 3.5 years, then it's starting to show up. So if you guys got any questions, ask them now because we're bailing real soon.
We're running out of words.
I'm not. I got lots of words. I've got so many words. The best words. The most beautiful words.
We can talk about other things.
We could.
There's
talk
always
about
stuff to talk about.
controversial things.
We didn't talk about it, hardly any controversial things.
That's a record for me.
It is. You're very controversial. You got a lot of opinions.
They're not always good ones. They're just opinions. They just kind of flap in the breeze. No, I think that's it. I think we did pretty good. Next month, like I said, it'll be automotive. It'll be some banking, and whatever else just happens to be flowing through. I would pay attention to Iran. I guess there's some drama happening there, and the negotiations aren't going well, and they're still murdering Christians. And
Hey, there's your controversial
there you go.
topics right there.
There you go. Yeah, who killed JFK?
I think it was a couple people, but I think the CIA was in on it. And
Oh, we really are going
I
there.
think Cuba also was in on it.
Cuba?
Yep,
Why Cuba?
because they attacked Cuba.
But like, we do that to every country all over the world all the time.
It was the whole nuclear thing, Russia put in nukes on Cuba and all that. No, I think I do really think the CIA had a hand to do with it.
You do.
Yep.
Sorry, I haven't been talkative. I am bagging up Star Wars fix. Really?
Bagging them up? You mean you took them out of the package?
There goes your net worth.
Oh, you sacrilegious, man. You actually played with them.
You did what they were designed to do. How dare you do that? No, that's fine.
You shrink wrap those and sell them on eBay now.
There's Rob does that.
Does he?
Yeah, he used to have all sorts of action figures.
Man, I had so many growing up.
Did you?
Wish I would have kept them. We had like the Millennium Falcon, we had AT-ATs, and we had
Really?
X-Wings. Yeah, we had the whole thing. We had all of it.
What did I call those? The AT&Ts?
We had
I think I
AT-AT.
called them ATTs when I was a kid.
ATTs.
AT&Ts.
AT&Ts. They're good communicators.
Yes, they are. They're very like vocal communicators.
I probably had thousands and thousands of dollars worth of Star Wars today that I could have sold.
I was.
And G.I. Joe.
Yeah, G.I. Joe was me. I had Ninja Turtles too. G.I. Joe's, Ninja Turtles, and Pog.
Yeah, I didn't have Pog.
And Magic the Gathering was
I had
me.
Magic the Gathering. Tons. I gave them all to my nephew.
He's taking to trade them in. Well, that's a sad day. That's a sad day. You're gonna miss that.
Wait, what are you going to trade them in for?
Tractor.
A tractor.
He's gonna buy a tractor just like me. We can brush hog a non-existent, like, my little plot vector.
A little brush. I don't know.
What he's going to do, Brian, is he's going to buy stocks.
Yeah.
He's going to buy stocks by trading them. He's
Going to
going to
trade
do
them
the
in for Rumble stock.
responsible thing just before the market crashes 40%.
Then he's going to cry.
Like the day after. It'll be just like me. I'm going to say, hey, taxes were great this year. We're going to, instead of buying a normal couple $1,000s, we're going to do $10,000. And then I do it. And then like China hits Taiwan and yeah, that'll probably be the way it goes.
You have your sad little tears and your big fluffy white pillow.
Big, expensive, fluffy white pillow.
It is. You don't do anything cheap.
I don't. Why not? Why don't I do that?
I don't know.
Because actually, I am cheap. You know why I do that is because I don't like buying the same thing 16 times. I like buying it and holding on to it forever because I hate busy work.
Well, yeah. Generally, more expensive things do last longer. Not always, but generally.
It's the same mindset of why you spend $35,000 on home projectors and stereos and stuff so you can save $50 per movie by not going to the movies. Total makes total sense.
Yep.
Total sense.
It'll take 13 years to pay it off.
Now in Michigan, the winter's maybe like 2 years. You can't get out. Going to Acme Comics outside Orlando. I will be in Orlando in September. Where is Acme? I'm gonna look them up.
It's in outside Orlando.
It's also somewhere
East Side's
in
right there.
It's in Florida.
It's an incredible place.
None of it's very vintage or very valuable. You know, I ever remember I had a paper route, so going back in time, and I used to take my earnings from my paper route in the '90s and went to I think it's Gold's Comic Store. I can't think of the name of it now, but we used to take it there and we would go to the comic store and that guy had like 11th issue Superman or something like that. He had some really old vintage stuff. If we had any money left over from the comic store, we would go to the arcade. Very much an 80s kid, like the Stranger Things kids. It was a lot like that because when you're a kid, you don't have a streaming service. There's not really internet to speak of. So you had your Nintendo and your bike. And your Nintendo got old pretty quick because it wasn't like this immersive world like it is now.
You have to keep buying new games. Or you play Gauntlet forever because it never ends.
No, it doesn't. You just end up eventually dying.
It just overheats, and then you got to stop it and start over at level 912.
Mostly Goodwill and thrift stores and garage sale buys. They are taking up too much space.
That's too bad.
Yep. Yep, I know that story.
You know, I never had really comic books growing up. I bought one series, which was Batman versus Predator.
Oh, really?
A crossover, yeah.
Okay.
Like a Dark Horse Comics or something like that they did a crossover. And I think there was like 4 comics that I bought. That was the series. That was it.
Mine was, if you ever watch any of our regular videos, it's Calvin and Hobbes. I have all of Bill Watterson stuff. That's where all my amazing humor comes from. It's not all self-originated, even though I take credit for it.
Longwood.
Longwood. Okay.
That was my nickname in high school.
Speaking of that, we somebody asked me Disney cost. I think I went through this with you last.
Yeah.
Yeah. So how much do you guys think it costs to go to Disney for like 2 weeks staying on site at the hotel and then like going to the park for 1 week, just 1 week?
And keep in mind, you're going through a service that bundles all this for you, not picking where to stay and the flights and all that stuff. It's all packaged.
This was just the hotel, so I didn't even have the tickets yet.
Okay. Or the flight?
Nope.
None of that? Okay.
Nope. I had to walk. I had to walk there.
I had a ColecoVision too. And an Atari 2600.
Hey, you guys are old. With the wood on the side?
Yeah, that was in the
The
front.
wood panel?
Yeah.
With the little silver lines. You could make them shiny. So I was looking up the cost of this Disney park, and I wanted to see, this is not what we ended up reserving, but it was $38,000.
How much was Art of Animation? Did you look that up?
I did not.
Oh.
The cheapest one I found was the Hard Rock Hotel or something, I guess. This one of the, and the room was obviously not anywhere close to the one that was 38 grand.
The one you looked up was like the one right there with the monorail going through. I mean, that was like the creme de creme of hotels.
That one was more. That one was like 70 some odd dollars.
Yeah, it's crazy.
It was, I can't, the thing that floors me is when I was looking up the price of this, it was like, oh, here's $38,000, and we're already booked out. Like I had to find a date that wasn't booked out already. I could not believe
You're
that.
going in what, September?
Yeah, who spends that much on a whole? I couldn't believe it.
Yeah.
So I found a resort hotel for like 1/10 the price, and
Oh yeah,
just down the
you could
street.
get better.
So it was.
Art of
it was much
Animation
better.
is right there, so you don't need to drive. So they have a shuttle that takes you right in there. So so if you go to Pop Century is the cheapest that's on site. That's where we stayed. Then Art of Animation is a little bit above that, and since you have 5 people, they have a suite.
Seven. I had 7 people. In-laws are going
Oh,
too.
in-laws are going to.
Yeah.
So you definitely need the suite.
Yep.
That's part of your problem, is why it's so expensive. But Art of Animation is the cheapest one on site that will allow for that many people. So you just need to find, and then I gave you the site to get the tickets.
And they only have 3 cockroaches per room.
It's Florida, man. You can't get around the cockroaches.
Or the lizards. I have the complete Calvin and Hobbes series too. That was really sad when Bill Watterson decided to stop doing stuff. He even complained about like the, I don't know, just the pressure, the deadlines, the restrictions, and I think that kicked him out. I think that's it. I think I'm done. You got anything else to add?
Nothing substantial.
Nothing substantial. Thanks for watching, everybody. We're going to come back next week. It probably will not be much about stocks because we already just made a stock purchase today. We'll probably be talking about current events and how they might relate to stocks. So if you got something you want to talk about, you got a stock that you want us to talk about, let us know. We'll talk about it.
Throw it in the comments.
Yep.
We'll read them.
Yep. And we will see you then. And as always, happy investing. Oh, fine. I'll do that. Happy investing.
Happy investing.
All right. Bye.